SoFi stock closed the trading day at $7.27 per share. This is a new all-time low. SoFi is down about 80% from the peak. So not looking so good. Your portfolios are not feeling so good because of SoFi, and I am right there with you. Now, on the other hand, we got to take a look at this article with a very bullish take on SoFi stock, and it really aligns with what I think, and I think you guys will find a lot of value out of it. Hopefully you do. Other than that, we do need to go over what happened in the markets today because there was catalyst. There was a reason why the markets were down so much today, and it comes down to options and this major option expiration that we did see today. So we are going to dive into all of this key information. If you guys find value out of this video, hit the like button, subscribe to the channel. Let's get this channel to 1,000 subscribers. Thank you guys for tuning in every single day and supporting. But without any further ado, let's dive into it. Alright guys, this is going to be a very important video. I do highly suggest you guys take notes or save this video, come back and watch it later because these things will come back up as the months do keep going. But it says ECB confirms the end of its bond buying in the third quarter as inflation surges. ECB stands for European Central Bank, and they are doing this because inflation is 7.5%. Now you might say, why haven't they done this sooner if inflation is 7.5%? Well, because if they do this, Europe is definitely heading for a recession, and they're likely already in a recession by June, July, August. I skipped July in there. June, July, August, you're going to get that second quarter data, and it's pretty much going to be confirmed that Europe is in a recession. A lot of that due to Russia and Ukraine, but Europe tends to be not as strong of an economy, especially after economies collapse. Europe's tends to take a lot longer to actually rebound. So it's weighing the odds of, do we let inflation continue or do we push the economy into a recession? And Europe is actually heading that route. Now they are voicing some concerns about raising rates, and they want to do it over time and very gradually. Not really what the Fed over here is saying, that they will do anything they have to get inflation down, even if that's 10, 11, 12 rate hikes in a year. They're taking the opposite approach. But what does this really show the global markets? It shows that Europe is actually acknowledging the ECB Lagarde, her name is Lagarde, showing that there is basically an uncertain outlook, that they are heading into a recession, that they do have to get inflation down, but they have to be very careful of that. That's why it's not really being seen as a positive thing today. And I think it goes without saying, anytime you restrict the liquidity and capital, it's not going to be seen as a very positive thing, but it's more reassurance that this slowdown is here and it is likely here to stay. Kind of the same way of when Jerome Powell does reverse and cut interest rates eventually. When that happens, like 2018, 2019, the crash that you've seen was actually the Fed coming in and cutting rates. It sends a signal to markets, and the way that they spoke today definitely sent a signal to the markets that the economy is not all too hot over there, and likely what happens in Europe will have an effect to us as well. So some investors definitely got the head start on hitting that sell button today. Obviously there's a lot of shorting activity that is also taking place, and on that note, directly related to the stock market, today is a large option expiration day. So that is definitely playing a big role into the volatility that we are seeing, especially when you get bad headlines like these. It's not that good, and it's not a good thing. And you also see big companies making very, very bad statements, like Amazon CEO Andy Jassy says costs from pandemic, inflation, and war are too high for company to absorb. Basically saying, hey, we're going to have really bad earnings coming in the next couple of quarters, to basically brace yourself. And a lot of this is really coming down to the consumer. The consumer is not doing too well. You're even seeing retail sales, where is that at? Right here, month over month, coming in below expectations. Expectation was 0.6%. Retail sales came in at 0.5%. Each 1 point is very, very important, because a 1 or 2 or 3 point difference really starts to send that signal that the consumer is slowing down. And I think it's like Econ 101. I guess a lot of the markets have just now come to realize that. But when you see an expansion of the economy at a abnormally fast rate like we've seen in the past 2 years because the government giving out money and all of that, you guys know the spiel there, you're going to see a contraction in some form of the other. The markets are trying to figure out how big is that contraction going to be and when is that going to start. And the retail sales kind of are telling us that it's going to happen pretty soon, and we're probably already in the phase where the economy is starting to slow down. Now, initial jobless claims also came in worse than expected, 185,000. It was expected at 171,000. So these are, kind of the leading indicators, retail sales and initial jobless claims. So initial jobless claims usually don't move the markets around all too much, but it might start to be a little bit more important to really see where the jobs are being lost. Some of the first jobs that go when a recession starts or is coming close is a lot of your construction jobs, a lot of jobs where they're not really permanent. They're more like, demand comes in for like home builders, let's say. The markets are booming, prices are going up, there's a lot of demand. You start hiring more home builders. Once that demand goes away, like we're seeing right now, you start to get rid of some of those jobs. So it's going to be very important to see where we lie in that realm. And as far as the last jobs report we did get, you did see a lot of jobs start to go away in the construction field, but as well as in the trucking field. So it's going to be very important to pay attention to this. Subscribe to the channel. I will keep you guys updated on all of this information. Now, those are really the big reasons why the market is actually selling off today. But on top of that, you're seeing a wild move in the bond market. Look at the bond rate, 2.827%. Just back here in March, the bond rate was 1.74%. We are 1.2% higher now than we were a little bit over a month ago, 5 weeks ago. This is sending mortgage rates through the roof, sending loan rates in general, whether it is margin rates, auto loans, credit cards are starting to go up as well, home loans, all of it is getting more expensive. When capital becomes more expensive, what do investors do? They take their foot off the gas and they put their foot on the brake and they start to sell things and they start to expect an economic slowdown, and that's what is being priced in right now. And you can definitely see this in the bond market. This rise is like unprecedented. You usually don't see rises like this unless something is really wrong, right? Drops or rises, not great at all. It's really telling you that investors are getting higher inflation expectations, because after all, for a 10-year treasury like the one we're looking at right now, paying 2.82% and going up, it's saying, hey, investors are not comfortable getting a 2.82% yield on their money for 10 years if inflation is going to be 8% per year. Really, to adjust out for inflation, these 10-year treasuries could continue to go as high as 3, 4, 5% in the next coming months. And that's going to add a lot of downward pressure to the stock market. And as bonds have been going up, the bond yields, the stock market has really not played along all too much. It has come down a little bit, but the whole time bond yields were rising in March, the stock market just continued to climb. So the stock market actually has some catching up to do on the downside to really pair up with the bond move that we have been seeing. So those are the big things that are actually affecting the stock market today, and they are pretty big deals. When bonds move like that, something to take note of, because the bond market is about 9 to 10 times larger than the actual stock market. So not all too good. I wish I had good information to bring to you guys here in this video. As far as SOFI stock, it goes without saying, SOFI would theoretically get hit by lack of demand. Now, SOFI is branched out into many different businesses. That's why I'm not so bearish on SOFI for the midterm here. Definitely not for the long term, but not really for the short or midterm, because they are so branched out, and SOFI continues to impress investors every single earnings release. And the fact that they did guide down actually gives them more room to actually impress to the upside. And I ultimately think you're going to see the market's very impressed with SoFi's resilience as long as they don't get bought out. There's always that catalyst that could come at any time if SoFi stock were to get bought out, but I don't think the shareholders would ever vote to approve that, and they would really need our votes because, like we went over, the largest holder of SoFi stock is actually, I believe it's Vanguard, a SoftBank group, and they have 10% of the float, but that's not enough to directly say like we are going to sell this company, right? You need 51% of the company to make that kind of decision. Nobody's even close to that as of right now. So I think all in all, I am bullish on SoFi, especially the lower SoFi does go. But right now, it's just not the right market conditions for investors to flood into these stocks. Now, once the Fed does kind of relax on their policy expectations, once the markets say, hey, maybe they're not going to raise 12 times in a year. Maybe they're only going to raise 5 times or 4.5% rate hikes. Maybe it's not going to be that 3 to 4% rate by the end of the year like we expect. That's when stocks will rally, and that's when a lot of these high growth stocks will actually be able to hold these rallies. SoFi has had these periodic rallies. Like we came down to $8, ran up to 10, right? Couldn't break 10, came back down to 7. But when that happens, you're really going to see that rally to 10, 12, $15, and we will be able to actually hold onto those gains. Now, that's basically that. That's the SoFi talk. That's the market talk. Let's get into the short interest and kind of what's happening on that front, because I don't think there's anybody that is really selling SoFi stock at these levels. As we have talked about many times, the short interest continues to climb, and I think a lot of this, or most of all of this actual downside pressure that we are seeing right now, is due to the short sellers. I think you've kind of run out of holders of SoFi that are selling, and I think the shorts have really taken over at this point, which is kind of scary if you're in this for a trade. If you're not really committed to SoFi for the long term, we could fall more. I do think the bottom is in, as long as the markets don't continue to be super fearful, or even if some of these stocks that have fallen a lot don't continue to fall as much, meaning that stock like SoFi down almost 80%. How much lower are you going to push the stock before you say, hey, we've done enough damage, probably should cover on our short positions, these stocks are worth a lot more, we don't want to get squeezed out, we'll just go ahead and cover. I don't know when that day will be. I don't know if it's at $5, $4. I don't know if it's at $7 where we are right now, but I know it will come, and we're going to get pretty good averages down, guys. It's going to be pretty amazing what we can do with the long-term just buying and holding of SoFi. So looking pretty good. As far as the short interest of free float, 19.87%. Current shares that are sold short, 143.14 million. Cost of bar max of 4.72%. Utilization of 100% in days to cover at 3.15. Now, I will point out, I don't expect a short squeeze necessarily anytime soon, but when it happens, you are going to see the biggest short squeeze across the markets that you have ever seen in a lot of these beaten down stocks. It's going to be absolutely insane. These stocks are going to rally 10 to 20% in a single day, and probably continue to rally when the market sentiment does actually switch to favor these stocks more, to favor the high growth stocks. And when a recession comes, believe it or not, tech stocks tend to outperform value stocks. Why? Because the economy is not growing. Investors want companies that offer some level of growth, which would be something like SoFi, Fubo, DraftKings. Companies that are growing will do well later on throughout this year. I am confident in that. Now, as far as the option activity, you're looking at about 51% positive order value, 9 orders totaling $10.89 million. You're still looking at a lot of those $5, $3 calls that are going through for the 2024 expiration. This one for $71,000. The last 2 minutes of trading, that order was actually put in. So it does look like you do have a lot of those longer dated options that are being bought up by institutional investors, kind of signaling to us we could be in this rocky market for quite a while, and these guys, they want to get some time on their option positions, which I don't blame them. And right now is a crazy good time to be buying those leaps that were just too expensive in the past. And that's what I plan to do as well, to get a little bit more leverage on my SoFi position. Now, Let's dive into this article and then let's wrap up this video. So it says, is SoFi stock done for? Since SoFi got its start in student loan refinancing, investors are worried about how the student loan moratorium might impact its future. In this week's episode, Aaron and I checked back in on some of the stocks we've been super bullish on as of late, most notably SoFi. Folks have been a bit on edge with stocks ever since President Joe Biden extended the country's student loan moratorium. SoFi got its start in the student loan realm, so investors are understandably worried about the impacts on SoFi's future. Us, not so much. Yes, it's true that student loan refinancing is a large part of SoFi's business today, but guess what? The moratorium doesn't change my bull thesis on SoFi stock one bit. Think about it like this. Once upon a time, Jeff Bezos hinged Amazon.com's success on selling books, just like SoFi hinged its success on student loans. But today, Amazon's book-selling business represents what? A fraction of a percent of its overall business? The same will be true for SoFi, as it's building an all-in-one super app in which student loan refinancing is an afterthought. It's why we call it the Amazon of finance. In short, SoFi's big picture vision is much larger than its student loan offerings. An end game, the student loan moratorium will register as just a little blip on the radar. But that's not all we cover this week. And then it goes on to say that. But long story short, in a nutshell, I think it sums it up pretty damn good. SoFi stock is the Amazon of finance. Put very, very well. This is not a stock you want to trade in and out of. It just doesn't move that much. But when it does move, when we do have solid legs to stand on in the markets, that's when you want to be fully invested in SoFi, in my personal opinion. Really, up until then, you want to build out this position. There's really no rush to FOMO into it, but definitely to start scaling in between 7, and if we do drop as low as 5, that's the golden range. That's really where you want to acquire as many shares as possible. After all, that's what the insiders have been doing. Also, as you guys can see, a lot of them bought in between $8 and $10 per share, so I feel very comfortable here at $7.27 per share. Nonetheless, thank you guys for watching. That is going to be it. Hit the like button, subscribe to the channel if you guys learned something. Save this video to come back to this information. The ECB, the bonds, it's all going to be very important. It all helps to restrict liquidity, which is not a good thing for the stock market directly. So thank you guys for watching, and I will see you in the next one.